The Federal Reserve wraps up its July policy meeting on Wednesday. And here to talk more about what to expect from the FOMC is Chris Beauchamp, a market analyst at IG Markets, with us now from London. And Chris, give us a few things you'll be looking for in Wednesday's statement.
I think if we're looking for maybe the three big things, at least the ones I'm looking out for, are firstly a discussion on inflation and how that's playing out at the moment. Of course, since the last meeting, we've had another drop in oil prices, which are pushing back towards their lows for the year. So while the Fed in the last statement was fairly sort of relaxed about the state of inflation, I think they might show a bit more concern that actually price growth in the US has started to weaken once again, reducing the rationale for a rate hike. The second thing, also the continuing rise in consumer spending, and that's been a long-running thing, and we're seeing decent earnings growth in the US from the average consumer, so that's still supporting, I think, the idea of a rate hike, but I think they'll be looking for solidity there. And then finally, any signs of dissent in terms of the actual decision. We've had 5 meetings in a row with no dissent from the final decision. If that starts to change this month, it could be indicative of something moving below the surface.
So in terms of the timing of a rate hike, I mean, when do you think the Fed will finally pull the trigger?
I still think that actually we might not see one this year. I think September seems a little bit too close even now, and I think December would be a bit of a brave move given the way the US economy tends to be weak over that winter period. So I think actually the Fed might stay its hand into the first quarter of 2016, perhaps go for a spring rate hike to allow the economy to get going once again in the new year. Some expectations about 30% chance of a rate hike in September, still I think unlikely given the underlying concerns we have, not just in the US economy, but also that turmoil we had in Greece and the ongoing volatility in China.
Even though Fed Chair Janet Yellen, in a testimony on Capitol Hill earlier this month, told lawmakers that a 2015 rate hike is likely.
Yes, certainly. I think Janet Yellen continues to sort of drop hints about the possible 2015, but the Fed's been very good at giving indications that something on its way and then changing the goalposts subtly so they don't have to meet that mandate. Of course, if one thing Janet Yellen is very good at, it's sort of keeping her options as open as possible. I think you can still read her testimony that we had recently to Congress, that actually she still wanted to stress that data dependent was the key theme here. The Fed has been very good at that and just sort of admitting that it is, if you like, a slave to data in the same way that we all are. And it just has to wait and see. I still think it's still a possibility that they hold off for this year.
Yeah, she doesn't like to provide a lot of color in terms of what's going through the minds of central bankers. I also want to ask you, what does the Fed need to say to please the markets? Is there anything in particular that would do that?
I think the thing, if you would say sort of please the markets or at least keep them calm, is the reassuring tone about the pace of rate rises being the far more important thing. That sort of don't look over here, worry about this instead. You know, don't be too concerned about the first hike because it won't be too rapid, it won't be too dramatic. It's the slow glide path, and that has been the big theme of even if we do move soon, it will only be very, very slowly. And I think that's the big thing, that the Fed's not about to imperil the recovery by moving too fast, too quickly.
All right, and just real quick, how do you think the markets will react once the Fed does raise rates, or do you think that first rate hike is already priced in?
I think broadly it's priced in. If you look at that 20% rise in the dollar index over the past year, equities still looking reasonably steady. I think markets have more or less factored in. We're expecting a sort of fairly gentle rise, 25 basis point rise from current levels. So not too much reaction at the moment.
All right, Chris Beauchamp, a market analyst at IG Markets, with us now from London. Thanks very much for your time.
Thank you.
I'm Scott Gamm, and you're watching The Street.